In this week's video, we'll review the latest charts, data, scores, and studies to help us answer the question, has a major bearish roadblock been removed for stocks? We'll be moving quickly, so feel free to use the pause button on your video player. Here are some of the topics we'll be covering. This is the opening slide from a segment from last week's video where we tried to determine which way the market may break near an important inflection or tipping point. And we noted there was a disconnect between stock market breadth, which was unquestionably a negative, and numerous longer-term setups that were unquestionably positive, at least from a historical perspective. And you may remember, we asked and answered the following question. If the monthly Copic signal turns out to be accurate, what could cause market sentiment and market breadth to improve dramatically? And one possible answer was that inflation would improve and potentially improve dramatically between last week's video and let's say maybe April of next year. And the data did take a step in the right direction this week. New York Times article dated November 14th, CNN article dated November 15th, CNBC article dated Wednesday, November 15th. Both PPI and CPI in the United States came in a market-friendly manner. We also saw some positive reads overseas. And that data helped move the market in terms of expectations much, much closer to cementing that the Fed is done raising interest rates. The market also believes we're getting closer to the first interest rate cut. And after the favorable inflation data, market breadth, at least in the short run, did improve dramatically. On November 14th, we saw a 90% NYSE up day, telling us that 90% of the volume on the NYSE exchange was associated with advancing issues, indicative of a very lopsided and bullish session. And we did see some improvement in the intermediate term data. The chart that we covered last week was able to pop back into the blue box, which is a step in the right direction. Relative to this disconnect, this is a very, very bullish look here from a longer-term perspective. And from a short to intermediate term perspective, breadth concerning. So logic told us either this was going to turn out to be inaccurate, or this most likely was going to improve. Another example of significant improvement in market breadth this week from Dean Christian's Sentiment Trader. NASDAQ triggers a rare breadth signal. And when something similar has happened in the past, when we're looking out several weeks, several months, all the way out to a year, a high percentage of the cases posted positive returns on the NASDAQ composite, and the median return, quite favorable. Doubling back all the way to October 27th, you may remember, there were some reasons to try to be patient, and there were reasons to be concerned. The market had shown next to nothing between October 17th and October 27th, and on Thursday, October 26th, the S&P 1500 composite broke an important level here. Wouldn't be unusual with a look like this to see something like the COVID plunge on the other side of it. Thus, from a risk management perspective, you really can't ignore this. This is hard data. This was the look on Thursday, October 26th. Index fell even further on Friday. It was down 0.8%. So we put this on the negative side of the weight of the evidence ledger. This was on the positive side, trying to take somewhat of a measured approach and patient approach. This is Friday, October 27th, SPY, trying to make a stand at a very, very similar level. Didn't hold this, but we were holding this. And as we covered on October 27th, the market did make a stand near a logical level during the session on October 27th, allowing us to take more of a measured approach heading into the weekend. Now let's revisit some of the charts that we talked about in last week's video, where we now had hard evidence of some significant bounces near extremely important inflection point regions. And we also noted that these stands were being made in the context of an S&P 500 that was still trading above an upward sloping 200-week in red here, and a NASDAQ composite index that was still trading above an upward sloping 200-week in red shown in the lower right-hand corner of your screen. We covered this chart, and this chart in the November 10th video. Another chart from November 10th, the S&P 1500 did make a stand, a short stay below this level here. To make an argument, it's similar to this look here and or this look here. S&P 500 a week ago, November 10th, similar situation. We went into the lower portion of this band, and at this point, you can say at least we've bounced. And again, noteworthy that all of this is occurring above that upward sloping 200-week shown in blue here. This chart dated November 10th is a weekly chart. You can see during the session on the 10th, the S&P 500 was down 11 points for the week. If we fast forward and look at the exact same chart a week later, during the session on Friday, November 17th, the S&P is up approximately 90 points for the week, taking on a stronger conviction look. So a week ago today, on November 10th, haven't clearly broken this downtrend yet. It's easy to make the argument that this look in here on November 9th is similar to this look in here where this rally attempt eventually failed. So no question, we have a lot of improvement off of this low here in October of 2023, just a few short weeks ago, but we still have hurdles to clear on the 9th and on the 10th. I believe we mentioned last week the battle was either going to be fought in this region up here or potentially down in this region here. If we fast forward to the end of this week on the 17th and look at an updated version of this same 39-minute chart, now we have a clear bullish breakout above that downward sloping trend line that goes back to the high that was made in late July of this year. And this concept applies to any bullish breakout or any bearish breakdown. The longer we remain above this region here and above these lines here, the more relevant it becomes. How about the gaps? The gaps are relevant, something to be aware of from a short to intermediate term perspective, but similar gaps occurred after a low in 2010, after the low in 2016, and after the COVID low in 2020. This point here, this point here, this point here is similar to what happened recently in October of 2023. Source of the information here, this is the Twitter handle. Right side of the screen, sentiment trader, combination of skeptical sentiment and improving technicals. Similar setups in the past. NASDAQ 100 was higher in 88% of the cases a year later. The average gain was 20.75%, simply telling us to keep an open mind about better than expected outcomes. Again from Sentiment Trader. Here's the tweet, here's the Twitter handle. Study is based on the concept of the gaps that we've seen recently. Similar SPY gaps in the past, 6 months later. Every single case the market was higher, median gain 11%. Another breadth-related study from Sentiment Trader. S&P 500 returns after 25% of the stocks close with a daily gain of 4% or more, which is that strong buying conviction off of the recent low. In the historical cases, market was higher in every single case a year later. Median gain was 31.6%. We've covered the concept of government interest in an increasing burden on the government and contributing to rising deficits numerous times in recent weeks and recent months. This is also noteworthy. Federal interest as a percent of GDP. Make an argument here that the present day level, very, very similar. It's actually a little bit lower in the present day over here than this 1981 reading here. And if you know your stock market history, 1981, 1982 was an extremely attractive time from a longer-term perspective to invest in the stock market. From the low in 1982, the secular bull market ran until March of 2000, roughly 18 years. Moral of the story, federal interest payments as a percent of gross domestic product are concerning, but they are not necessarily a showstopper relative to a secular bull market, and in this case, a secular bull market that was fueled by extremely positive demographic trends trends that are very, very similar to the trends that we have in place in 2023 and the trends that will be in place over the next 9 to 12 years. Chicago Fed National Financial Conditions Index. There's a little blurb down here about the index. Moral of the story, financial conditions in 2023 are much more favorable than they were during the financial crisis. Financial conditions in 2023 are much more favorable relative to the double dip period here, double dip recession in the 1980s. And financial conditions in 2023 are significantly more favorable relative to financial conditions during the high inflation period in the 1970s, way up here, and during the 1973-74 bear market. Doubling back to the VIX study, you can find it by Googling the title on your screen here and our last name, Shavako. VIX made a little bit of a run recently, but never made a run at the high 20s or low 30s. And during Friday's session on November 17th, it was trading under 14 at 1388. Let's look at the data from the secular volatility model to see what we can learn. Quick reminder on the concept, secular trend window, looking at 1953 to 1974. The sweet spot of that window is 1950 to the end of 1968. From this low here in 1953 to the high in the upper right-hand corner, point B, gain in the S&P 500 was roughly 429%. That's the good news. The bad news is there was a lot of volatility between point A and point B. When it's complete, the secular volatility model is going to help us answer numerous questions. Question A, within the context of a secular trend, how do we discern from a probability perspective between the blue boxes and the orange boxes? The blue boxes being the strong portions of the secular trend, the orange boxes being the more vulnerable portions. And the objective in the blue box is to try to leave it alone and stay invested. And the objective within the context of the secular trend in the orange boxes is to mitigate drawdowns and avoid eventually something like this. And near the end of October, you may remember the market's profile using numerous metrics, including the secular volatility model, said vulnerable. Secular volatility scores range between 0% and 100%, and you may remember we said that studies told us that the tipping point was somewhere in the 45% to 55% range. And in the drawdown cases where the tipping point tips in the bearish direction, the median drawdown, even during the strong portions of the secular trend, additional drawdown was approximately 16 or 17%. Could be much worse near the end of the secular trend. So where do we stand the week before Thanksgiving? On Thursday, October 26th, very, very close to this tipping point range with a score of 57. You may remember the S&P 500 lost an additional 19 points or so on October 27th, and thus we were even more susceptible to an additional drawdown, additional double-digit drawdown. Your inflection point becomes a tipping point if you roll over in a bearish direction. It's also possible in this inflection point range, if you don't tip over, that the market will improve and possibly improve relatively rapidly as it did in this case. Score on November 2nd all the way up to 78%. And if we fast forward to November 15th of this week, we've moved from a low in the 40s all the way back into the 90s. As you can see, sharp reversals are not uncommon. In fact, they are quite common. So you can go from a low score to a much improved score rapidly, low score to a much improved score rapidly, low score to a much improved score rapidly, etc., etc. So what do we learn from this vulnerable score here on Friday, October 27th, relative to the score on November 15th? The scores in late October told us until things improved, we were vulnerable to additional downside, and in some cases, significant downside. And conversely, the fact that we're back up into the 90s tells us the odds are most likely that we have left the orange box, and there's a much higher probability that we're returning to a blue box in a much more stable portion of the secular trend, with the key word being probability. you can get some pretty significant bounces within the context of an orange or a red box. We're in a much better place, but we never want to be complacent relative to risk management and the markets. And you may remember the base portion of the secular volatility model answers over 450 questions about the market's profile. We can focus on different questions and we can weight the answers to those questions in different manners to use all of that data to help us answer numerous questions. So let's talk about the question or portion of the model that we've been working on recently. Remember, we stated earlier the strongest portion of this secular trend is from 1950 in the lower left-hand corner of your screen to the end of 1968 up here. Markets operate in fractals, thus the concepts that we're covering here relative to trends, they apply to all time frames. Trend is stronger here, weakens a bit here, rights itself for a period, and then shows some additional weakness here, 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 and here. And from a general concept perspective, if we compare the area down here to the area in this region here, to this region here, this region here, this region here, and this region here, for the most part, that area is increasing over time, and that's a function of this trend getting weaker and more vulnerable over time. This looks different relative to this, and this foreshadows this. So another question that we want to ask and answer, and we can do that via the same data, we're just going to use a subset of it. How do we discern between the stronger portion of the secular trend and these periods here where the market is much more vulnerable to a very, very painful drawdown? Why is this relevant? Because hypothetically, up here at this point in late 1972, early 1973, if our account was worth somewhere between $10 million and $500,000, and we hypothetically experienced a drawdown similar to the drawdown in the 1973-74 bear market, and that drawdown peak to trough was 48.02%, financially, that would be quite painful. That would be a $4.8 million drawdown, hypothetically, on a $10 million portfolio, and a $240,000 drawdown, hypothetically, on a $500,000 portfolio. And then, hypothetically, when you get down to this point here, that exact same account statement would look more like this. And even from a pattern recognition standpoint, it's pretty easy to see that this, and this are different from these looks over here. And conceptually, when you're modeling the past, when you're modeling a secular trend, how can that possibly be helpful? Because we're dealing with human beings and greed in fear. Trends are trends. Uptrends are uptrends. Downtrends are downtrends. Studying and understanding human psychology during a secular trend is really no different than using a 200-day moving average as a reference point. The 200-day moving average was a relevant reference point 30 years ago, and it's still relevant today because human nature, greed, and fear have not changed significantly. So since we're using a weight of the evidence approach, it's possible to adjust our parameters. If we're using multiple inputs, it can become a little bit more clear now that this up here is significantly different from all of this back here. That's true visually, and that's true mathematically. And as we said previously, this look here foreshadows this extremely painful drawdown here. So if we're looking backwards from this point here, our median scores are going to be dropping relative to looking at median scores in here. How can all of this potentially help us manage risk and reward in the present day? It's noteworthy. From the early stages of the secular trend here in 1950, this massive drawdown over here doesn't occur until year 25, with the trend slowly getting weaker and weaker and weaker over time. We said earlier that this, in some ways, foreshadows or tells you to be open to something like this. So in the present day, you really don't want this chart to look like this. You really want it to look more like all of this back here. And it's also relevant. How does the present day chart look if we go back 25 years? We didn't run into something like this or this on the left side of this chart. If we look at the exact same chart today and go back 25 years, that takes us to this point here in late 1998. From a pattern recognition standpoint, this in here between 1998 and the low here in 2009 really doesn't look anything like this in here. And it should be noted, the CCM secular volatility model is based on 3 periods, not just the period on your screen here. The 1950 to 1968, 1950 to 1974 window would be period 1. Period 2 is that 1982 to 2000 bull market, fueled by strong demographic trends. And we've also looked at the current secular bull market that began somewhere near 2012 and 2013. All of that is taken into consideration when we construct the model. This is a strong secular trend. This is a period of secular stagnation. Do we ever see a look like this or a look like this in this window here? The answer is no. Price makes a stand, price makes a stand, price makes a stand. Price can't make a stand, price fails to make a stand. So back to the present day chart. If we fast forward to the present day, how concerned should we be about something like this or this? And if a secular trend can last 20 to 25 years, how long has our present day chart taken on a secular trend characteristic? How deep into this are we? It's probably fair to say that this window in here really can't be included because this doesn't look like a secular trend. Thus, somewhere in this period here in 2012 to 2013 is where that transition takes place. With the benefit of hindsight, 2012 looks a lot like 1950. Walking forward from 1950, there's a lot of white space underneath the Bollinger Band. Walking forward from 2012, there's a lot of white space below the same Bollinger Band. And if we take this 25-year scale here, this being kind of the gray area for the secular trend, this is still your highest high, but your trend is weakening in here and your risks are higher. So we walk forward from 2012, January 1st, 2012, 25 years, hypothetically that would take us to 2036. So from a long in the tooth perspective, historically, this, year 12, really doesn't look anything like these periods out here. We still have that strong secular trend look, with the present day looking more like this period in here relative to this period over here, or this period of secular stagnation in here. And this back of the envelope projection telling us we can make a rational argument with evidence that 2036 would be similar to 1974 aligns with a similar time window and conclusion from June of this year. June 16th video, using different methods, we said the bull market hypothetically could last until 2034 or 2035. And in terms of time, that would tell you that the secular bull would end somewhere in here, and it's over here in 1974. So relative to all of this and relative to all of this, there's really nothing here that contradicts any of this from the June 16th video, which you can find by Googling the title on your screen. And remember, in the first stage of development, we're trying to answer this question. How do we discern between the blue boxes and the orange boxes within the context of an ongoing secular trend? And since one of our goals is to significantly mitigate a drawdown like this, we also want to use all of this data to try to help us discern or answer this question. Do we still look like we're in a secular trend, or does it look like we're starting to bleed over into this red box? The more we look like this on the left side of your screen, the higher the desire to stay with the ongoing trend. If you manage risk, you want to put the capital back to work if it still looks like the blue box on the left. And that's not going to be the case if the data starts to look more like the red box on the right. Thus, we're currently working on a second iteration, a second way to use the exact same data set. And in this case, you're really saying, do we still look like we're in a secular trend? So let's call that score B. Score B as of November 16th was 100%. So instead of saying it still looks like a secular trend, now we have a data-based, unbiased way to evaluate the answer to that question. Are we still in a secular trend? The higher the score, the higher the probability, we're still within the context of a secular trend. The lower the score, the lower the probability, or the higher the probability, we're moving into something like this. So the scores that we've been talking about in recent weeks, let's call that score A. Score A being 95% earlier this week. Remember, that helps us discern between the blue boxes and the orange boxes within the context of a secular trend. And score B helps us answer a different question. Why is all of this helpful? Because you're going to manage the drawdowns differently over here relative to over here. When score B is high, as it is today, you're going to give the secular trend the benefit of the doubt. Conversely, when score B starts to drop, you're going to be much more skeptical about redeploying capital. To summarize, the concepts that we talked about a week ago still apply. Numerous markets, including the NASDAQ, S&P 500, S&P 1500, and countless important ETFs recently held at an extremely important inflection point region. And these intermediate term stands that are still in place on November 17th occurred within the context of still favorable, very long-term setups. All the key markets in the United States, all the key equity-based ETFs above upward sloping 200-week moving averages for the most part. So on November 17th, it looks like the question that we asked last week relative to how was this going to be resolved seems to be leaning, at this point, heavily towards the bullish camp. The setups, favorable setups, are still valid, and market breadth has started to improve. Still got a lot of work to do. So at the moment, we're in a much better spot relative to where we were on Friday, October 27th. From an evidence perspective, pretty easy to say that the secular trend is still intact, and thus we're back to a point, based on the data that we have in front of us, where we can give the primary trend the benefit of the doubt, while acknowledging we've got a lot of moving parts. Deficits, inflation, Fed policy, interest rates, a slowing economy, ever-shifting probabilities related to expectations, tied to the Fed, and tied to the question of whether or not we're going to go into a recession or dodge an economic recession. Thus, while things have improved over recent weeks, we still have to respect numerous risks and the uncertainty that we're dealing with. We have been and will continue to adapt to the new world with a longer-term bias towards higher inflation, higher interest rates, and higher market volatility. If those trends remain in place, we have to keep in mind there's always counter-trend moves. As we're doing with the secular volatility model that is used in conjunction with the CCM market model, it does not replace the CCM market model. It's important that we continue to look for ways to improve. This bullet point here says, based on everything we know today, we will most likely be rewarded if we take a longer-term view. It's much more important relative to what happens over the next 2 years rather than the next 2 weeks to 2 months. In this type of environment, things tend to resolve to the upside. So far, it seems to be playing out that way. But at the same time, if the data shifts in a meaningful way, we're going to have to reassess the probabilities. And the only way that we're going to be able to do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.